Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Wednesday, March 22nd, 2023. Today is Fed Day, but we're going to postpone our Fed discussion for a little bit here this morning, and then we'll have a special edition this afternoon after Chair Powell takes the microphone. We're actually going to start across the pond this morning in Britain. We're going to look at the CPI that came out. We actually saw it going the wrong direction. We saw it moving up significantly in terms of year over year and also into the core reading. So this emphasizes something that I think will overhang the market today, tomorrow, and for the rest of at least the first half of 2023 is inflation. It's hard to put the genie back in the bottle. Concerns continue to be that supplies and orderly markets are not regularly occurring. We have seen anecdotal comments in the ISM manufacturing pricing index, and we saw it yesterday in the existing home sales. Yes, existing home sales were better. We went up to 4.5 million instead of 4 million on an annualized basis. So it was a healthy move, around 15%. And we saw some decrease in price. Actually, it was the first retreat year over year that we had seen since 2012. So maybe there was some hope in the housing numbers. However, inventory remains low, under a million. We should be seeing a 1.4 million. Now, I traded private equity for a while before my current opportunities. And what I'll tell you is you need many buyers and needed many sellers to create an orderly market. And we don't see that yet in housing. That continues to keep prices elevated and keep trades challenged. Yeah, third week in a row that we've seen purchasing mortgage applications better. 10-year is down. That's helping a little bit in that area, but there's really a long way to go. And a thriving, healthy housing market includes lots of sellers and lots of buyers, and we don't have them yet. And we do need a healthy housing market, move beyond the issues that we have in the economy. That's actually even dovetailing into the banking crisis that we're facing right now. Why is that? Because housing has a very important effect on other parts of the economy, household formations, and repairs, and furniture, appliances. When people buy a house or thinking about selling a house, there is a cascade of economic activity that goes on. When this part of the economy is struggling, it really does affect the market. And so the Fed sits here today to comment about the economy, but more importantly, talk about the safety of the financial systems. And really, when we had problems with loan generation, and that goes back to Sarbanes-Oxley and even Dodd-Frank in terms of the pressures that have been put on banks in terms of loans and how it happened from the great financial crisis. What was forgotten about was the other parts of the asset element of their balance sheet. And what did start going longer and longer and longer, according to FDIC, is both community banks and other banks extended their investment portfolio. Their portfolios became even longer and longer, and that cascaded into long rates going lower and lower, and then the asymmetrical nature of interest rates, probably not going to go to zero. Probably most likely when you're at 1, it's going to go higher. Not surprising. That's what happened, hurting those parts of the portfolio and then making liquidity a struggle as banks were accumulating assets and had to find some way to make money on those assets. So that was sort of the dilemma. So we have the Fed today talking about both inflation, so what we started this discussion with, and the banking system, and they all sort of sit together. as we move forward. And they have got to provide confidence in the system. And I think that's an important, but a recognition of the inflation element that continues to percolate into the economy. Do they establish a very high terminal rate, or do they give a sign that once this inflation element moves, they will quickly move back to a normal curve? And that will actually indicate and give some direction to the 10-year and how it works. Yes, inflation expectations have fallen. We're now sort of worried about inflation in 24. That's actually kind of come in a fair amount too, and maybe even a potential element of disinflation, or should I even hazard a guess, some deflation, which would then sort of percolate the need for easing. These are all in a quagmire of events that both set the challenge and the bar high for the chairman, and we'll be back later today and sort of give a sense of how he did and how he raised these issues. But it's important to note that these issues are quite interconnected, and through that interconnection, there is not an easy solution. This is Scott Murray for the Daily Economic Market Shout. Thank you for joining me.